Okay, let's unpack this for you. We're diving into how to cut through all that noise in your financial life. You know, that feeling. Maybe overwhelmed, kind of trapped, definitely anxious about what's next.
Yeah, that feeling is super common. Financial stuff can feel like a maze, jargon, conflicting advice, markets going up and down.
Totally. So you wanted clarity, confidence, right? And a
Yeah,
solid playbook. We're going to use the insights from Tony Robbins, especially from his book Unshakable and some other material you share.
exactly. Get past the confusion.
Right. So that's what this deep dive is all about. We're going to pull out the most powerful, like the really actionable stuff from this material for you. Our mission is basically threefold.
Okay,
First, we got to nail down the core problem Tony Robbins is tackling, why all this financial anxiety exists in the first place.
makes sense. Understand the why,
Second, we'll pull out the main ideas, the big principles you need to really get your head around for a solid financial future.
the foundations.
And third, and this is key, how you can take these ideas and actually use them, like right now, immediately in your own life.
And kind of woven through all that, we'll explore what the author really means by becoming unshakable. It's not just wishful thinking, right?
No, definitely not. It's about having real security, real peace of mind.
So where do we start? The problem itself.
Let's jump right in there. The author, Tony Robbins, he really gets that feeling of being, trapped or anxious about money. He talks about feeling it himself earlier in his life.
And that personal angle, it seems like it really fueled him, didn't it? Especially seeing what happened after the 2008-2009 crisis.
Yeah, exactly. He saw how bad decisions or maybe reckless behavior in the financial world just hammered regular families.
And it kind of highlighted how the traditional system, it can often feel like it's working against you, the average person, not for you. Like navigating a minefield blindfolded.
That's a good way to put it. And a huge part of that minefield, according to the author, fees. Hidden fees, excessive fees. This is like a massive point in the material.
Oh, it's huge. He really hammers this. Think about this. You could lose like a decade, maybe even 20 years of your retirement income.
Just from fears.
Just from paying slightly higher fees over your lifetime. Maybe 1%, 2% more each year. It adds up massively.
A decade or two lost. Wow, that's staggering. And what's worse is how hidden it all was, right? The book mentions 401k providers didn't even have to legally tell you the fees until 2012.
Yeah, 2012. Imagine all those years people were just saving kind of in the dark about what it was actually costing them.
So it's no surprise then, that statistic he shares, something like 71% of people think their 401k has no fees.
And 92% admit they just don't know what they're paying. It's wild.
I remember seeing that mention of Robert Hilton Smith's study, finding, 17 different fees buried in just one 401k plan?
17. And it wasn't just the ongoing costs. Some funds hit you right at the start with a sales load, like 5.75% gone before your money even starts working.
Ouch, that just eats into everything.
It really highlights how complexity can benefit the providers, not always the saver. And the author specifically points out folks like teachers, nurses, people in nonprofits with 403B plans.
Right. They often had even less protection historically.
Yeah, less regulatory protection compared to 401ks under certain rules, making them potentially more vulnerable to high fees.
Okay, so you've got these hidden costs draining your savings. Then there's the whole who do you trust issue. The material talks pretty frankly about some financial advisors having conflicts of interest.
Yeah, putting their commissions ahead of what's best for you. He uses this striking image, almost like a cartoon.
Oh, yeah, I remember that. Clients asking for advice from these big institutions.
Right, labeled banking, brokerage, trading, and they're all kind of teetering on this shaky foundation labeled trust.
It really captures that feeling of uncertainty about the system, doesn't it?
It does. And the book doesn't shy away from pointing to past industry issues, like Wells Fargo's fake accounts or Barclays rigging interest rates, LIBOR.
It's not saying everyone's bad, obviously, but it's saying, look, these conflicts exist. You need to be aware. You need to be vigilant for yourself.
Absolutely. So you've got fees, potential conflicts, and then there's just the market itself. Corrections, bear markets, they happen. They're normal.
But they trigger fear, right? And that fear leads to emotional decisions, panic selling.
And that, the author argues, is often the biggest danger. Selling low, locking in losses.
Yeah, that cartoon he includes is painfully relatable. Dad explaining the stock market. Put money in, lose money, panic, sell.
And someone smarter buys it cheap. Crucially, you miss the rebound. Being out of the market during the recovery is devastating.
Because our own brains, our psychology, it works against us sometimes in investing.
Yeah, definitely. Our biases, our emotions, fight or flight kicks in, not patient, rational thinking.
Okay, so that sets the stage. The anxiety, the fees, the fear. How do we get past all that? How do we become, as Tony Robbins puts it, unshakable?
Well, he defines unshakable as more than just feeling positive. It's about having the real insights, the right tools, the skills, the strategies.
So it's a practical stuff.
Very practical. And having a plan that's so solid, you have this like emotional strength. You can sleep at night even when the markets are going crazy.
Okay, so let's get into that playbook, the core strategy. He boils down what the best investors do into these core four principles.
Yeah, the core four, if you only focus on a few key things, these are apparently the ones.
What's number one?
Number one, do not lose. Sounds simple, maybe obvious.
Yeah, don't lose money. Got it.
But it's deeper. It's about fiercely protecting your downside, prioritizing capital preservation.
So it's not about zero risk, but smart risk management, like Howard Marks saying, proceed with caution.
Exactly. And Tony Robbins says, he tells his own advisors, like, don't even pitch me an idea unless you first tell me how we're protecting the downside, minimizing loss.
Building resilience, expecting surprises, like Ray Dalio says.
That's it. Principle number two, asymmetric risk reward.
Okay, asymmetric, meaning unbalanced.
Yeah, unbalanced in your favor. Forget risking a lot to gain a lot. The pros look for chances to risk a little, but potentially gain a whole lot.
Ah, okay. Risking one to potentially make 5 or 10 or more.
Precisely. He mentions Paul Tudor Jones and his 5-to-1 rule. Risk $1 only if you see a path to making 5.
And the crazy thing is, with that rule, he can be wrong most of the time.
Like 80% of the time wrong and still not lose money overall, because the wins are so much bigger than the small losses.
That's powerful, finding those skewed opportunities.
And the book points out these often show up when everyone else is panicking. During market corrections, during bear markets, like 2008-09. Terrible time for many, but for prepared investors.
Heavenly opportunities, as he puts it.
Right, like that trust deed example, relatively low risk, knowing real estate had to crater massively to lose principal, but offering a great return. Low risk, high potential reward.
Okay, core four principle number 3.
Tax efficiency. Maybe sounds a bit boring, but it's absolutely vital.
Because it's not what you make, it's what you keep after taxes.
Exactly. Taxes are a huge drag on returns. The author contrasts, say, actively managed funds.
Which trade a lot, generating capital gains taxes.
Right, often short-term gains taxed at higher rates. He contrasts that with simple, low-cost index funds.
Index funds just track the market, right? Very little trading.
Minimal trading. So way lower transaction costs and much lower tax bills. You keep more of the growth. Plus, using tax-advantaged accounts like IRAs, 401k is crucial. Growth is tax-deferred or tax-free.
And the material briefly touches on other tax stuff too, right? Like estate planning, using trusts, and even basic life insurance choices.
Yeah, mentioning things like irrevocable trusts for passing wealth efficiently, and how simple term life insurance is usually better for protection during your working years than complex, high-fee variable life policies. It's all about maximizing the net amount you keep and pass on.
Makes sense. And the fourth core principle.
The classic, diversification. Don't put all your eggs in one basket.
Oldest rule in the book.
But still so important. And it means diversifying, not just across different stocks, but across different types of assets.
Stocks, bonds, maybe real estate, other alternatives.
Right. Things like MLPs, private equity. And diversifying globally. Don't just invest in your home country. He points out this home bias trap.
Like the example of Japan after 1989, if you were only invested there.
Ooh, yeah. A long, rough period. Diversifying globally smooths out returns. And the mix of these assets, asset allocation, that's actually the biggest driver of your long-term results. Way more than picking stocks.
So these core four give you a framework. What about dealing with the market's ups and downs psychologically?
Yeah, the book stresses understanding market history. Every single bear market in U.S. history, every single one, has eventually been followed by a bull market. Recoveries happen.
Remembering that pattern is crucial when fear takes over.
Absolutely. The market looks ahead, not at today's scary headlines. He mentions his partner, Peter Maluk, guiding clients through 08-09 by constantly reminding them of history.
And their assets grew because clients stayed put, didn't panic sell.
Exactly. They trusted the process, the history. It really underscores that Warren Buffett quote.
About the stock market transferring money from the impatient to the patient.
That's the one. Patience and discipline win.
Which brings up another key point from the material, finding an advisor you can actually trust, given the fee issues and conflicts.
It's critical. The book lays out what to look for. A team with broad credentials, CFPs, CPAs, maybe attorneys, not just investment pickers.
Because your financial life is bigger than just stocks and bonds,
Yeah.
right? Taxes, insurance, estate planning.
Exactly. You need holistic advice. And crucially, check their philosophy. Do they align with these core four principles? Are they focused on low-cost, diversified, tax-efficient strategies using things like index funds?
Or are they claiming they can beat the market by picking stocks?
Which the author basically says if they claim that, run the other way. And definitely look for a fiduciary, someone legally required to act in your best interest.
Maybe even get a second opinion if you're unsure about your current advisor.
Absolutely a smart move.
Okay, so we understand the problems. We have the core principles. Now let's make it super practical. Thinking about you listening right now, what are some immediate things you can actually do?
All right, number one, pay yourself first.
Oh.
Make saving automatic. Set up a transfer for a percentage of every paycheck straight into your investment or savings account, your freedom fund. Don't even let it hit your checking account where you can spend it.
Automate it. And maybe challenge yourself on that percentage. Could you bump it up from 10% to 15% or even 20%?
Yeah, that story of Theodore Johnson, the UPS worker, is so powerful. Never a huge salary, but saved 20% consistently.
And ended up with what, $70 million?
$70 million.
Yeah.
Just through discipline and compounding over decades, it shows what's possible.
Okay, what else can you do right now?
Attack those fees.
Yeah.
Seriously. Get your 401k statement, look at your mutual fund reports, find the expense ratios, ask point blank, what am I paying?
And look for lower cost options like index funds within your plan.
Definitely. Push for transparency. Every fraction of a percent you save on fees stays in your pocket, compounding for you.
Then, once you're invested smartly, stay invested.
Yes. Resist the urge to time the market. Studies show it's basically impossible to do consistently well. The real risk is being out of the market during the big upswings. Be patient. Think long-term.
Build some kind of safety buffer, too.
Right. The book talks about a rule of 7, aiming for 7 years of income in safer income-producing assets like bonds or MLPs eventually. That lets you ride out downturns without selling your growth stuff low.
7 years is a big goal, though. Maybe start smaller.
For sure. Start with building, say, 3 to 6 months of essential living expenses in a safe, easy-to-access cash account. That's your immediate emergency cushion.
And beyond the investment side, what about basic planning?
Get your basic estate planning documents done. Seriously. Everyone needs these. Doesn't matter how much money you have now. It protects you and your family.
Okay, what are the key ones?
Durable power of attorney for healthcare. Who makes medical decisions if you can't? Durable power of attorney for finances. Who handles your money if you're incapacitated? A living will, your wishes for end-of-life care. And a basic will, or maybe better, a trust.
A trust helps avoid probate court, right? That public, potentially slow process.
Exactly. It keeps things private and usually makes distributing assets smoother for your heirs.
And finally, check your insurance.
Yeah, just a quick review. Is your homeowner's coverage enough to actually rebuild your house at today's costs? Understand the details. And if people depend on your income, look at term life insurance. It's usually the cheapest, most effective way to protect them while you're building wealth.
So lots of practical steps. But the author keeps coming back to the mind game, doesn't he? Mastering your psychology.
Because that's often the biggest hurdle. Our own emotions, our biases, they trip us up.
Like confirmation bias, only looking for info that supports what we already think.
Yeah, we all do it. In politics, investing. We filter out opposing views. The book also mentions impatience, wanting quick riches, and greed. Tony Robbins even shares his own early mistake, losing money on a hot stock tip.
And Wall Street kind of feeds those emotions, right? With constant news, flashy trading apps.
Totally. It encourages short-term thinking, emotional reactions. So how do you fight it?
Seek out different opinions. Have a system.
Exactly. Have a checklist, a disciplined process like Paul Tudor Jones used. And maybe most importantly, tune out the noise. Stop checking your portfolio constantly. Ignore the daily predictions. Guy Spear calls it avoiding the candy that fuels bad decisions.
It all ties back to this idea of real wealth, doesn't it? That financial freedom is a tool, but not the ultimate goal.
Right. True wealth is more about your state of being, your fulfillment, your emotional life.
He talks about beautiful states versus suffering states. Love, joy, gratitude versus fear, anger, frustration.
And he highlights gratitude as a powerful way to shift your state almost instantly. You literally can't feel truly grateful and fearful or angry at the same exact moment.
Is that the simple gratitude exercise he describes? Breathing into your heart?
Yeah, feeling your heartbeat, thinking of 3 specific things you're genuinely grateful for. Could be tiny things, could be big, and really stepping into those memories, feeling the gratitude fully. It's a quick way to change your physiology and perspective,
And underpinning all this is that core belief. Life happens for you, not to you.
which can be hard to see in tough times, obviously. But looking for the lesson, the growth, the strength that comes from challenges. That's a powerful frame. He shares that incredible story of Alice Hurt's summer.
The pianist who survived a concentration camp.
Yeah, and maintained her spirit, found gratitude even amidst unimaginable suffering. It's an extreme example, but it shows the power of inner resilience, the core of being truly unshakable.
Okay, wow. We've covered a lot. Based on all this, you listening might have some specific questions popping up now.
Definitely. Like, okay, how exactly do I find out the real fees in my 401k? What specific words do I use?
Or if I'm looking for an advisor, what are the killer questions to ask to ensure they're a fiduciary and really align with this approach?
And what if you can't afford a formal advisor right now? What are the best, like, DIY low-cost options for actually implementing these index fund and diversification strategies?
How do you decide on the right asset allocation, that mix of stocks, bonds, etc., for your specific age and goals?
And maybe just how do I even start getting those basic estate documents, like a will or power of attorney? Where do I go? Who do I talk to?
Yeah, those are all really practical next step questions that naturally come up from this material.
Absolutely.
So just to recap our journey here, we started with that feeling of financial anxiety, that overwhelm. We dug into the core principles Tony Robbins lays out for building real, lasting, wealth-protecting downside, seeking asymmetric reward, being tax efficient, diversifying.
Then we looked at concrete actions you can take right now. Automating savings, slashing fees, staying invested, building a safety net, getting basic planning done, and crucially, managing your own psychology.
Because becoming unshakable isn't magic. It's about knowledge, having a solid plan, and developing that inner strength, that emotional fitness to handle whatever comes your way.
And the really empowering thing here is, so much of this is within your control. Forget predicting the market. Focus on what you can control. Your savings rate, your costs, your diversification, your reactions.
You have the power to build this foundation, to make it strong, regardless of the headlines.
So here's something to think about, a final thought to reflect on from this deep dive. If we agree that achieving financial security is largely about discipline, consistency, managing yourself more than the market.
Which seems to be the core message.
Right. Then what is the single smallest action you could realistically take, maybe this week, to move just one step closer to being more disciplined or managing your emotions around money better?
Could be tiny, like deciding not to check your stocks tomorrow.
Or automating an extra $20 into savings. Spending 15 minutes just looking up one low-cost index fund in your 401k options.
Or even just trying that 5-minute gratitude practice once.
Exactly. Whatever that small step is for you, just remember the incredible power of those consistent small actions. They compound over time, not just your money, but your confidence, your peace of mind. That's how you build real, unshakable wealth.